Hey.
Hey, how are you?
Yeah, we're fine.
I'm sorry, I'm all over the place today. It's 3 weeks to final exam. I'm a little crazy, so it's helter skelter. So I have about 25 minutes today because I have 3:15. I have to get ready for class.
Yeah, don't worry about it. We have a couple of questions.
Actually, before I go any further, I will send you the dates for when I'm going to be in Prague in May, and if we could get together, because my session runs from like 3 to 5, and so if I can make it out, and if you can do something in the evening, and I can do it, I'd be glad to do it.
Well, you actually said that it's 26. I mean, we have the dates, right? The conference is fixed.
So
it's just about the timing, actually.
Yeah. So I think my session ends at 5. I turn the lights on, so it's not as dark.
Okay, so we can safely assume something like 7?
7 sounds good. How's traffic in Prague? If I finish at 5, it's not going to take me like 2 hours to get to something.
You can walk in 2 hours.
Okay. Good.
Like 10 times at least.
So what session are you guys on?
We finished with the 16 lectures, so we basically completed the intrinsic valuation.
So you're ready, right?
Yeah, we will have the quiz 2 in next week.
Okay, so let me ask you a question. What's the first step in intrinsic valuation?
Okay, somebody can answer that. I think that the first step is to pick a company.
That's true. That was the easy step. What's the next step?
Yeah, I get the first step.
Estimate cash flow.
Is what? I'm sorry?
Estimate cash flow.
Was estimating cash flow.
No. You jumped a step. Before you open a spreadsheet and you start estimating cash flows, you need to tell a story. Right? All valuations start with stories. The story will drive, because if you open a spreadsheet, here's what's going to happen. Because you have no anchor, your numbers are just going to be extrapolations from the past, right? So you're going to take the revenue growth from the last 5 years, you're going to project it out. You're going to take the margins from the past and project it out. You're just going to be a projector of historical information, and that's all you're doing. Let's face it, I don't need you, right? I can build a spreadsheet to do it. I can do an app. I can create an app to do this. The very fact that you're there is basically so that you can take the historical data, and you can use it still, but you need to tell me a story about the company. I'll give you an example. This morning I posted on my blog a valuation of Valeant. You familiar with Valeant? This is this Canadian pharmaceutical company that grew from nothing to this very big company over the last 5 years. It became a favored stock for investors like Bill Ackman, who's the activist investor, and the Sequoia Fund, famous value investing mutual fund. And it's a company that seemed to pull off what I call the trifecta in valuation. It's a company that seemed to be able to grow revenues by about 20% a year while maintaining these huge profit margins and earning huge returns on capital, huge excess returns. So if you think in terms of numbers, the company looks just amazing. So if I'd shown you the company just in terms of numbers and you did the projections, the value per share you'd have got for the company would have been about $210 per share. Stock was trading at about 180. But here's what worried me about the company. When you take a deeper look at how they grew so fast while being profitable, what they did was they did acquisitions of other pharmaceutical companies. And they would buy pharmaceutical companies with a lot of debt, so that's the first leg of what they did. And they would buy pharmaceutical companies with underpriced drugs. There's a moral and ethical component to that. Underpriced drugs in the sense, you have a heart drug that somebody needs to stay alive, it's being priced at $200. Valeant would say, well, we can charge $2,000 for that drug and get away with it. So they would buy these companies and reprice the drugs. So it's a business model that actually is built on acquisitions funded with debt and repricing drugs after the acquisition. You're saying, what's wrong with that? I'm not going to raise any moral or ethical questions, but when I looked at the model, the question I asked, the thought that came to my mind is, this works as long as people don't notice you. Because once people start noticing that you're repricing drugs, it's going to create a backlash. You're going to be politicians getting up. You're going to the insurance company saying you can't do that. And the problem was Valeant was getting too big to be under the radar. So in the middle of last year, people started asking questions about the repricing. So how come you're raising the price 800% or 1000%? And that triggered kind of a re-examination of value as a company. So by September and October, the company was starting to come apart. The business model was breaking. So I actually valued Valeant in November. And when I valued Valeant, I said there's no way they could keep doing what they did. The old story of we can grow through acquisitions, we can reprice drugs, that's no longer going to work because people know what you do. They're noticing what you do. So the story I told for Valeant in November of 2015 was I said, this company, in spite of its historical success, is going to look like a traditional pharmaceutical company. So with low revenue growth and relatively low margins and excess returns that were good but not great. And I revalued it at about $77 per share. That was November of 2015. The stock had dropped from 180 to 85, but I still felt it looked a little overvalued. Well, here's what's happened in the last 6 months. Valeant was supposed to file its annual report in February of 2016. The date came and went, and they said, we can't find the information yet. So the earnings report got delayed by 1 week, 2 weeks, it's in fact 2 months in, and they still haven't filed the annual report. So the first problem that's happened is information is completely, there's an information blackout. The second is the management team is in complete disarray. The CEO is going to have to step down, the CFO is under some legal cloud. Problem is, Deborah that looked so good when times were great, when they were doing all these acquisitions, now that debt is coming back to bite them. They have a lot of debt and there are covenants that are kicking in that might push them into bankruptcy. So when I sat down to value Valeant last weekend, I said the old story is not going to apply. This isn't a cash cow pharmaceutical company anymore. This is a dog. You know the BCT framework, the consulting framework, a dog is a company you don't want to touch. It's a dog. It's a dog because it has too much debt, its margins are going to break down, there's no management, there's no information. And you know what? I valued it as a dog. Which means that when I sat down to value Valeant last weekend, the revenue growth I used and the margins I used were very different than what I used in November. The value that I got for Valeant, even though there's been no new information about the company, is now down to $45 per share. The stock is trading at 31, so I bought the stock. But essentially it shows you how as my story shifted, the value of the company also shifts. So the first step in intrinsic valuation is don't go into Excel spreadsheet. Think about a story. Try the story out and somebody who you trust will give you good feedback. Because it's actually, I just finished this, it's my latest book, it's coming out in a few months, called Narrative and Numbers. And basically it's about connecting storytelling to valuation. Because there are lots of pure number crunchers out there. And guess what? They're going to be outsourced sooner or later. There are lots of pure storytellers out there, but they have absolutely no discipline. If you can connect stories to your numbers, your valuations will become richer and much better. So the first step is think about the story for your company and then start to open the spreadsheet and say, how will that story play out in my numbers? Because that will give you some added heft to your valuations. So so the intrinsic value part, you did cash flows, and you did discount rates, and you did growth rates, and you did the terminal value, right?
Yeah.
What's the scariest part of those 4 inputs?
Terminal value.
The terminal value, right? Why? Because you screw up there, everything else gets wiped out. So somebody tell me the 4 simple rules to keep your terminal value in check. You can start with 1, and I'll fill in the rest. What are the rules you have to follow when you do terminal value calculations?
Okay, so I probably start with the reinvestment rate.
Well, let's start with the growth rate. If you're going to use the perpetual growth model, what's the cap in your growth?
And the growth of the economy.
The growth of the economy, in which case you have to then tell me what that's going to be. And the good proxy for that, and one I like to use is the risk-free rate. So first rule in terminal value is don't let your growth rate exceed your risk-free rate, which means that you guys have a problem in Europe, right? Because you're approaching not just 0, I think in the Czech Republic, the risk-free rate might actually be lower than 0. Are you guys in negative territory yet?
We used to have negative, it's still negative.
If you have negative risk-free rates, guess what? Your growth rate has to be a negative number as well. You're going to bitch and moan about that. Say, what? My company is so good. I don't care. You got the benefit of a low risk-free rate. I'm going to come back and say, no, you can't use that high growth rate you want to use. Your growth rate has to be capped at your risk-free rate. If you're valuing a company in Swiss francs, the highest growth rate you can use in your terminal value calculation is minus 0.25%, because that's what the Swiss franc 10-year bond rate is right now. That's the first rule. Second, as you point out, you need to reinvest to sustain that growth. What does that mean? Well, if you want to grow 2% a year, you have a return on capital of 10%, you have to reinvest 20% of your after-tax operating income. You can't say, well, I don't like to do that. You have to reinvest enough to sustain that growth rate. Third rule, if you make your company a stable growth company, give it the rest of the characteristics of a stable growth company, which means your cost of capital has to be. So if you're valuing a high-tech, high-growth company, what you get is the cost of capital today, which is 11 or 12%, cannot be used as your cost of capital in terminal value, because that's a very different company. And the fourth rule, don't wait too long to let your company become a stable growth company. Because the median growth period for a high growth company is about 3 to 5 years. So when you use a 10-year growth period, you're already way out there in the 95th percentile. Don't make it a 25-year or a 50-year growth period, because that's going to get you into trouble. If you follow those 4 rules, your terminal value will not run away from you. And in fact, if you set your return on capital equal to your cost of capital, your growth ceases to matter. You might as well use a zero growth rate. It's excess returns that deliver value. So keep that when you look at the terminal value. It's a big number, it's a scary number, you're worried about it taking overvaluation. If you follow those rules, it will not take overvaluation.
By the way, this leads me to a question, is that many people who don't like DCF because of the terminal value effect, some of them propose to use residual income model, but you never mentioned that. But you are actually using it for banks, right?
I just told you that, right? Indirectly, the residual income shows up in my terminal value. How? My growth and reinvestment offset each other. So if I set a return on capital equal to the cost of capital, my terminal value is going to become my invested capital base. That's what it means. So I think people who use the residual income model are very fond of accounting numbers. I'm not. Right? And I think there's another reason people often don't like DCF. A big percentage of your value comes from your terminal value, right? 70, 80, 85, 90% of your value comes from terminal value. And that freaks people out. And my response is, when you buy a stock, if you buy the right kind of stock, of course, when do you make your money? You don't make it while you hold the stock, you make it when you sell the stock. It's price appreciation that drives returns in stocks, not the dividends you receive while you hold the stock. This kind of cash flow valuation holds up to the mirror to how you make money. If most of your money comes from price appreciation, your terminal value should be a big percentage of your value. Because that's what the terminal value is doing. It's capturing your price appreciation component of your total returns.
All right, so I would start with my question.
Yeah.
I was thinking a lot about this thing. We are also using the Wall Street prep materials, and I tackled one thing, which is treating cash in the cost of capital, right? So what they are doing is that they are using net debt in the debt part of the formula. But then what is the consistent way of accounting for cash? Because you account for cash already in beta, right? Because you have lower beta.
Right. If you use net debt in your cost of capital, you got to use net debt to equity to lever your beta. So let's take an example. Let's suppose you have a 50% gross debt ratio and a 20% net debt ratio. When you use the gross debt ratio, you're going to end up with a much higher levered beta with the gross debt ratio than with the net debt ratio. But when you do the cost of capital, debt is going to be weighted more because the gross debt ratio is higher than the net debt ratio. The net effect of my cost of capital will be relatively small. It won't be zero because we are making different assumptions about how cash is taxed. But whatever you gain by having a lower beta when you use net debt ratio will be exactly offset by the fact that debt will be weighted less than the cost of capital, which will lead to a higher cost of capital. So the net effect of, the one thing about net debt ratios, you want to use net debt ratios, use them everywhere. And that includes companies like Apple, where the net debt ratio is what?
It's negative.
It's negative, and you have to be okay with it. Which means when you do your net debt to equity, you will actually end up with a levered beta that's lower than your unlevered beta. That's okay. When you do your cost of capital, your debt ratio will actually be a negative number. Minus 30% in equity, we want 30%. If you're okay doing that, I'm fine with net debt ratios. We actually end up with pretty much the same cost of capital at the end. So if you're going to stay in net debt ratio, stay with it all the way through.
So that says that once we are using regressions beta, which already accounts for the cash basically, we should always use net debt, right? In the case you are
that doesn't necessarily follow. Regression betas reflect both your debt and your cash, right? So I can do it in two steps. I can unlever using a gross debt ratio and then tell you how much of that beta comes from cash and how much comes from non-cash assets. It's just algebra. It's two steps. If you prefer to do it as one step as a net debt ratio, that's okay too. We'll arrive at the same place when we're all done. But in a sense, I'm just doing it in two steps. First with the gross debt to equity and then bringing in cash as a separate asset. You're just doing it in one step by netting the two up.
Okay, but then, so with the regression beta, it's consistent not to use net debt, right?
You can use either gross debt or net debt, again, as long as you're consistent.
I mean,
that's what I'm saying.
If you keep the beta as it is from the regression.
A regression beta is always a levered beta. It reflects both your debt and your cash. So if you have a lot of cash as a company, regression beta will reflect that. If you have a lot of debt as a company, your regression beta will reflect that. If you have a lot of debt and a lot of cash, your regression beta will already reflect that. So regression beta just reflects what you have as a company. What I do with the regression beta will reflect whether I decide to go the gross debt route or the net debt route.
Okay, thanks. So then we had a couple of questions. Okay,
go ahead.
Who's gonna start?
Maybe you can ask them because I don't know whether I could be heard.
Can you hear the guy?
I cannot, so you'll have to repeat the question to me.
Okay. Yeah, I think that the question was whether you ever analyzed companies from this region, like Czech Republic, Slovakian, Polish companies.
Can I make a suggestion? Tell me the name of a company, your least favorite company to analyze, because it's really messy. Maybe I'll do it on May 26th when I come back.
Okay,
I will do it, sir.
Do you have a suggestion?
I'll tell you, Eastern Europe is pretty boring to analyze, I'll be quite honest with you. It's a boring part of the world because, I'm sure it's an exciting part of the world in other parts, but the stock markets are full of old, boring companies for whatever reason. So send me a name of a company that you think is exciting, that is trying something different, disrupting a business, changing the way you do things.
To be honest, I can't come up with any company which isn't a stable company already.
Yeah. So. But that reflects East Europe's history, right? I mean, in a sense, you don't get listed unless you're a stable, mature company who's already making money. I mean, you don't see too many Ubers listed on your market yet.
No, we don't have Ubers at all.
That's part of the reason I stayed away from it.
We don't have Ubers at all. It's not like they are not in the stock exchange.
I have to tell you, I did value a Croatian tobacco company. That's about as close to Eastern Europe as I've got, is Croatia. I valued a Slovenian company, but I'm working my way north, so I'll get to the Czech Republic sooner or later. I'll be there. Yeah.
Great, awesome. So, other questions?
So I would suggest to value Kofo.
Well, it is traded already, right? Yeah. Okay, so we will send you a link of company.
That's good. Do send me a link and I will value the companies for May 20th.
It's actually owned by a Greek family, so well, whatever.
As long as Putin doesn't own it, I'll do it.
No, he doesn't. He doesn't. Okay, so questions. You said you had a question. Oh. Okay, so what about your question?
Mine?
Yeah.
How do you value these mobile apps? For example, Facebook bought an app, Masquerade, a month ago for like $10 million or something like that. What do you do with that? How do you count it?
The question I always ask is, how do you plan to make money? An app is never by itself. You can't pay dividends with apps, right? You can't make it. So an app has to make money. And there are two ways an app can make money. One is through a subscription model, where people subscribe to the app. I'll give you an example. Pandora has a subscription model. You pay $3 a month, you get to listen to as much music. Spotify is really an app with a subscription model, or it has to be advertising. If it's a subscription model, it's relatively simple. You got to estimate how many people will subscribe to the app and multiply by the If it's an advertising model, it's a little more challenging because then you have to ask the question, will people actually buy stuff based on ads on this app? And I think the answer depends on the company. And in fact, about 2 months ago, I valued Facebook and Twitter I did these pairs of companies. I did Amazon and Netflix, Google and Apple, and Facebook and Twitter. And the reason I picked Facebook and Twitter is both have lots of users, right? But Facebook seems to have figured out how to make money off those users. And Facebook is very good. Whenever they supply a new app, that app is designed to drive you into the Facebook ecosystem. So you think about Instagram, you think about WhatsApp, it's all designed to drive you to the Facebook ecosystem so that they can make money off it. So they're very good, and that's, I think, one reason why my value per share for Facebook has gone from like $30 to 45 to 86 in my most recent valuation. Each time I look at Facebook, they impress me because they've figured out new ways to monetize users. In contrast, think about Twitter. 310 million users, and they haven't figured out how to make money off it. Maybe some of this has to do with the kind of app it is, which is, 140 characters, you got to be stuff to get advertising in that. But it's really a company which has potential but hasn't figured out a way to convert users to money. So my Twitter valuation has stayed at about $18 for almost 3 years now because they haven't figured it. So to me, that's the breakthrough, is when apps figure out a way to make money. And let's face it, 90% of apps will never make money. So if you're a venture capitalist, that becomes the challenge, figuring out which 10% of apps will actually end up making money for you. Not how many will download it and how many users it has, but how do you make money off those apps.
So you wouldn't go for valuing these companies based on real options theory? Like 50?
You could, if you could figure out ways in which you could exploit. Real options would be an add-on. I'll start with a traditional discounted cash flow valuation, but I would still, at the end of the process, say, because Facebook has 1.7 billion users, if they can ever figure out a way to do other stuff with these users, it adds to my value. That's where the real options argument will come in. So don't use it till the very end. If you start off with a real options argument, it means that you have a very weak argument to make. So start off with a conventional, traditional intrinsic valuation and then say, I'm going to pay a premium on top of that because I think there's optionality.
Okay. So do we have some more questions? Okay, good.
But I don't have to scream out aloud. So.
Okay, don't come.
Hello, sir.
How are you?
I have a question regarding the session number 7 or 8 when you were valuing Uber.
Yeah.
Where their original calculation was like $2 billion. The corrected one or the adjusted one was, I think, like $17 billion. And everything adds up, everything works. Sounds great until you have to take the money out of your pocket. And I'm quite older than the others here, and I remember the dot-com bubble from 2000 to 2002, when the companies were, I call them zero but promise companies, were priced, I don't say valued, but priced quite highly, and then something happened and they were worthless. As far as you remember this period, did it somehow change your view on the valuation of these startups?
I think that it's almost impossible to value companies in a vacuum. When you value companies, you always... Did I lose you? Okay.
No. It's just that, the camera doesn't take the whole class.
Basically, when you value a company, your history follows it, right? So I've been through the dot-com boom. But one thing I've learned in markets is don't overlearn from history, right? Because there's so many lessons we try to draw from anecdotal evidence that they don't hold up. So there are things I learned from the dot-com boom and bust, but I'm not going to let them drive how I think about social media companies. Because if I come and say, hey, this is just a repeat of the dot-com boom, then I'm going to miss some really good companies out there that will succeed in spite of the fact that collectively social media companies might be overvalued. Now, Uber, I'm going to continue to value. I don't think Uber is a zero-value company. I think it has substantial value. And I think the question is whether people are overvaluing it, and they probably are. What does that mean? I won't be investing in Uber, but I'm not going to stop somebody else from putting their money in. because that's their money. That's their judgment to make. So that's the way I think about all investing. It's not my job to stop other people from investing. It's my job to make sure that I'm investing in a way that's consistent with the way I think about investing.
By the way, the dot-com bubble leads me to another question. You mentioned once, and I don't remember, I think it was Cisco, that you mentioned that you found it to be overpriced, but you didn't find a way how to make money out of it, right? Because
that's actually true, right? It's easier to make money when something is undervalued than when something is overvalued. It's very difficult to take a long-term stand against overvaluation.
Yeah, you mentioned that you could short sell it, right?
Only for short periods, right?
Or you could buy put options, right? But you could also use a strategy short call, right? You could have been selling call options. So why didn't you?
No, but remember that long-term options are a recent phenomenon available only in a subset of companies. They weren't available until about 5 years ago. Options were had 3 month time period. So you'd have to be right, and you have to be right in 3 months to actually make money.
No, I don't mean buying option. I mean selling. You could have been yourself selling, and I mean, am I messing up a bit? Put options.
You'd have to buy puts, right?
Or
but you could have bought only a 3 month put.
Or sell calls. You could have been issuing
calls, but you'd have sold a 3 month call. That was the time period. The options, listed options, have 3 month to 4 month lives.
Yeah.
And only recently have you had these leaps, which are long term options. So in many ways, I couldn't have done any of those things 5 years ago, 10 years ago, because those options wouldn't have existed.
But it does limit you for selling options, right? If you
but selling or buying options. If you're buying listed options, you have to buy based on what's available out there. And most options have short time horizons. So whether you buy or sell, you're stuck with a time horizon, right? You have to be right within that time horizon to make money.
But what I'm thinking about is that if you are the one who is issuing the options, you are just, collecting the premium. And as long as you're right in the process, it doesn't matter for you.
Well, what if in the next 3 months, the price moves in the opposite direction? Right? You can make the assumption that if you find something to be overvalued, it won't go up even more. But remember, you're talking about a momentum stock, right? In a momentum stock, things can move. You can go bankrupt. Never sell an option and walk away from it on a momentum stock. That's like selling short on Amazon last year at 300 because you thought it was cheap, it was expensive, and finding it go to 600, which is what it did. It's a very dangerous game. Don't play it.
Yeah.
Guys, I have to get ready for class in like 2 minutes. I'm sorry it got shorter because I had another Skype before, so I know I kind of was late coming to the session. But you know what? I will make sure that I evaluate one of your companies when I come out there on May 26th, and I hope to see many of you there. I mean, that will be fun.
Yeah, it will be. So just let me know a little bit about the timing, and we can make it.
Okay, and you will arrange the room and stuff, right? So
everything is settled already. It's reserved.
Okay, good, perfect.
Awesome.
Thank you.
See you then.
Take care.